So regulators in India recently banned a US company called Jane Street in freezing over $500 million or so in alleged illicit gains tied to index manipulation. In simple terms, as I read, the firm is accused of placing complex trades in a way that um, unnaturally moved index levels to their advantage, essentially tilting the playing field so that they could profit, supposedly at the expense of everyday investors. And if the name Jane Street sounds familiar, it should, because one of its former traders, a guy by the name of Sam Bankman Fried, better known as the founder of FTX, disgraced founder, in someone who went on to become pretty central or a pretty central figure in the crypto world before, of course, his spectacular downfall. So the idea of the markets being rigged, this just being one example, isn't necessarily new. Back in 2014, journalist and author Michael Lewis brought this notion into the mainstream with his bestseller book, Flash Boys. And in it, he argued that the trading firms, the market makers, as they're called, executing on behalf of large institutions, were using technology to front run trades. And we're talking about literally milliseconds of advantage. Amplified, of course, across a massive trading volume and translating into enormous profits and kind of fed the public the perception the market was tilted in the favor of these supposed insiders. Now, these headlines and books, there are reminders that while the cast of characters may change from high frequency traders to crypto celebrities, the story is largely the same. Someone always seems to find an edge, but I'll argue here the long-term, properly diversified investor is relatively immune to whether or not the market is actually rigged. Now, setting aside the large institutional players, let's examine this bigger question of the market, the stock market, indeed being rigged. Short answer, absolutely. Absolutely, yes, in my view. I think it's impossible for it not to be rigged because there will always be things that people, not all people, will know, and furthermore, who will be willing to act upon. Now, when I say rigged, I'm talking about mainly short-term trading advantages and insider edges, not the long-term investor's experience. The long-term, properly diversified investor, as we just said, is relatively immune from these forces, in my opinion. Now, are there people with inside information able to act without being caught? Sure. My mentor, David Malik, and I have talked about extensively, and he's seen studies that, so have I, that suggest a link between a certain percentage of the initial climb of a stock price connected to perceived inside information. Now, closer to home, I'm reminded of something we observed a number of years ago at our firm. At the time, we held a company within our strategy called Virgin America. That was founded by the billionaire Richard Branson, and this airline would eventually be purchased by Alaska Airlines. And the acquisition was great news for us because we own Virgin across a number of accounts. And when the purchase was announced, the acquisition, the stock jumped by somewhere around 40% that day. It was a huge run up in the company. And we've experienced similar things before that, and then of course since then. But that jump was one of the better one-day stock moves that we've seen. And what was interesting about it was, in looking back at our records after the fact, you look back at the chart and you can see that we had owned the stock for a little bit more, I think, and again, this is going off of memory, but more than a year before the announced acquisition. We also noticed that in the months leading up to the acquisition announcement, the stock had risen by roughly 30 or 35%. And this is the kind of thing that makes me wonder, well, was there any news? Like, were there, over the months leading up, were there any kind of super positive earnings results that carried certain companies upward? Was there something going on in the airline sector that would have caused Virgin America and others to move? We looked back and we really couldn't find any information that points us in that direction. Could it have been an improved outlook? Sure. I don't have any proof otherwise. But absent any real news, especially in a sector like the airlines, the timing of a 35 or so percent climb, soon followed by acquisition news, is at least interesting to me. But then again, who cares? Why hypothesize about it? I don't think it's even up for debate, really, that the market is somewhat rigged. Let's just say it is. What I'll also say is that individual long-term investors, as individual long-term investors, we don't care if the market's rigged or not. We simply don't care. And the reason we don't care is because it doesn't really affect us. We're not traders. We don't care about short wires and millisecond execution advantages and micro fractions of dollars that end up making a difference because of the sheer volume in which they are transacted. No, as long-term investors, when we trade in a company, we're looking to hold that company for as long as the analysts that we use continue to raise their earnings estimates. Our hope is to hold on for as long as that is true so that we can benefit from the appreciation of the stock over time. The fact that along the way, other traders, institutional otherwise, might be trading in and out of that security multiple times and legally or perhaps illegally, in some cases, gaining a fraction of a fraction of a fraction of a penny on each transaction doesn't really matter to us much. Ultimately, the price of the stock is not going to lie. In the long run, the price of the stock is going to reflect a multiple of whatever the company's earnings turn out to be. That's what we're looking for as long-term investors. We're looking to own a company today in which the expectations of the earnings by our analysts continue to increase, not once, but hopefully numerous times in the future. And of course, if they don't, we get rid of it, we replace it with another company. And analysts, they are wrong plenty. They get overly optimistic sometimes, like everyone else, but in the end, stock prices follow actual earnings. Now, for traders, and also if we're not focused on necessarily fundamentals, if we're not focused on the future of the company, but focused solely on the price and its ups and downs on a day-to-day, hour-to-hour basis, then the argument can be absolutely made that the so-called rigged markets might be eating into our potential profits. As long-term investors, we know the market is entirely unpredictable in the short term, days, months. On a long-term basis, though, I'd make a really strong argument that it is entirely predictable. The empirical evidence is there. Earnings ultimately drive stock prices. If you look back historically, going back to the end of World War II, for example, you will see that the earnings of companies in the S&P 500 have risen. Don't quote me. This data is a little aged, but it holds somewhere around 70 times their earnings increase. And when you know it, the price of the S&P 500, the aggregate sum of all the stocks it represents, has also risen roughly 70 times over those decades. That tells me while the stock market in the short term oscillates wildly and can be very volatile, ultimately the stock price ends up being a pure reflection of what the company actually earned. The takeaway for us and the folks that are worried that people are gaming the system is that this should not be your focus or any of your attention. What people need to be worried about is being invested in the markets without a viable strategy. You can't complain about losing in the market, so I suppose you can, but you shouldn't be complaining if you don't have a process or strategy that can actually create success. You can sit there all day about the institutional players affecting your returns, but if you take a step back for a moment, do you actually have a time-tested process that's been proven to be successful? As investors, we must have the humility to acknowledge that our losing money as a result of winging it is not necessarily somebody else's fault. Certainly, there's plenty of shady business dealings out there. And that's why we need regulations, oversight to ensure that the institutions or others aren't overstepping to the detriment of individual investors. But I'm also going to ask you to consider this issue from maybe a little bit of a different angle. And let me ask you, have you ever driven your car over the posted speed limit of a particular road? Now, you may protest that this is somewhat of an unfair comparison to make because we're talking about, on one hand, large amounts of money, on one hand, and speed limits. But I'm simply trying to point out that as human beings, we are self-interested. It is part of our wiring. We put our interests ahead of others as human beings, even though some of us attempt to be mindful and present to that nature. If the opportunity exists to have an advantage, someone, if perhaps not you, but others will go for it. You don't need to look any farther than the time that you were late for your son or daughter's baseball game, and you may have run over your own grandmother to get your kids to the game on time. I'll plead guilty to this once or twice. I've done it when I wasn't being present to my behavior and the potential negative impact on others in going over the speed limit a little bit. So that when people are shocked when somebody is gaming the system, can they also not believe that someone would be willing to go 10 or 15 miles over the speed limit in certain circumstances? Would you now believe that someone bought stock on insider information? I'm not condoning the behavior at all, nor, of course, do we do it at the firm. But it would be naive to pretend that it's not happening. I know comparing insider trading to speeding isn't really the perfect analogy, but the human wiring, in a sense, is the same. So what's the answer? How do we get ourselves kind of out of this? I don't think that we can undo the human tendency to want to get ahead. I don't think we should. But what we can do is take responsibility for how we invest money. Instead of complaining about all the things that are happening to us, instead of seeing ourselves as victims of a rigged market, we need to figure out all the things that we can do to put ourselves in a better position. This begins with us having a strategy that is reasonable, realistic, and time-tested. Let's face it, isn't just about everything in life rigged to some extent? What are we to do? Quit? No, we recognize that we have a choice. We open our eyes, we look at the situation realistically, and we make better choices. We choose not to gamble in our future necessarily. We choose not to fantasize about miracles. We choose not to compromise our vision or our ethics. And that's really what drove the creation of the GPS, the goals planning statement. And before that, the investment strategy, to give ourselves a framework that keeps us disciplined, regardless of what other noise is going on out there and whether or not the market is rigged or not rigged. We choose our way to a better future.